Hi, welcome live from the CNBC set at the Nasdaq, where I've just been briefly interviewed. Actually, my answers were way too long. I was briefly interviewed on the subject of Diamondback-Endeavor, which you may have heard me saying on TV. We think is a great deal. We put out a note in October talking about the heavyweight thesis of US E&P, showing that the bigger the better as it comes to E&Ps nowadays, essentially because of the concern over inventory and the need to be a high inventory company such as a Hess in a world where people have a lack of conviction over the sustainability of cash returns. So the companies are doing a great job of cash return. Now the market's worried, how long can you sustain that for? And the bigger you are, the more your inventory, the more conviction the market has that you can sustain cash return. And that's the only real reason to own an oil company if we are indeed at the end of the oil age. Whether we are or not, the market's going to tend to price it as the end of the oil age as much as it's going to price this as the beginning of the AI age. Neither of them are particularly correct in my view, but ultimately that's the way the market's going to price these things, and I think that's quite natural and we're not going to fight it. So essentially we do think that cash return is the key, and ultimately if you want to drive sustained long-term cash return, which is what the market will capitalize, you need a lot of inventory, and of course to that end Diamondback's deal for Endeavor is great. I think additionally Diamondback is a bit like Yates when it sold to EOG, is a special situation where these guys, the margin, Autry Stevens, the totally charming chairman emeritus, let's call him, of Endeavor, the owner essentially of Endeavor, completely charming and lovely guy, told me 5 years ago, I just want to drill wells. He's known to drive a battered pickup truck, and I can tell you that if you think Diamondback has modest offices, which they do, very low cost operation, you should see the Endeavor offices. They really are low key. For a company that would ultimately be sold for $26 billion, frankly, you might have thought it was just a small-time accountant's office in Midland. And ultimately now, having sold itself for $26 billion, I don't think that the marginal billion here or there, in all honesty, makes much difference to Autry Stevens. It's much more about the kind of work that you can see Diamondback's done with Endeavor in terms of some of the charities, some of the local initiatives they've taken in Midland to make Midland a better place. And that's why I think Diamondback also is a low-cost operator with a pretty clear succession plan. Travis Stice, very well established as CEO, but Kees van 't Hof, CFO, well known by the market as president, clearly is ultimately very likely to take over. And so with Autry having a succession issue himself, evidently, as he ages into his mid-80s, it wasn't clear who in his family wanted to take over the job of running Endeavor. So Diamondback becomes a very natural partner, and by extension, Diamondback gets a great deal for really one of the two remaining great asset bases, a real diamond in Endeavor in terms of its asset base in Midland. FANG gets a tremendous overlap here, and it looks all good for the company. At the same time, with Devon, we have rumors that they might be buying, or at least on Reuters, stories that they might be buying Enerplus. It's quite the opposite for us, because we were working for the past couple of weeks on a note on Devon, concluding that what Devon needs to do is actually sell everything. And the key rationale for that, sell everything except their premium Permian position, and the key rationale for that is that Devon is actually trading at a similar valuation to Diamondback in absolute dollar terms, in EV terms. Devon's about the same EV as Diamondback. For very, very similar Permian positions. The only thing is Devon has another 270, I think, thousand barrels a day of additional production that the market's essentially giving it no value for. So our argument was that Devon should sell its Bakken, should sell its Eagle Ford, should sell its other bits and pieces, and focus on becoming a pure play Permian player, which is frankly probably too much for Devon to handle. And so it's not a surprise that Devon's looking at a Bakken deal. It's just that in the note we wrote, we highlight that Devon's Bakken performance since it did a major deal a year or so ago has actually been disappointing, and it's not clear that they're necessarily the best people to operate in the Bakken, and the market's not necessarily going to be thrilled by a deal for Enerplus. But you literally might see that within the next 24 hours. It was in Reuters. Wall Street Journal had the Diamondback story, and the Wall Street Journal, you can take it to the bank. The other guys tend to be a bit more random on whether deals happen or not, but the story nevertheless is that Devon for Enerplus is a deal that actually we don't support. We think, depending on the pricing of course, we think Devon should actually be shrinking itself down to a core of Permian, and that would take its multiple up and its attractiveness up. But of course, as people have pointed out in feedback to the note, a point that we made in passing is that Devon CEO Rick Moncrief had a lot of his career with Continental with a lot of expertise in the Bakken. So much as it fits for Diamondback and Endeavor to be getting together at Midland, so by the same token, it kind of makes sense that Devon would be wanting to buy more Bakken. It's just that the performance of their last Bakken acquisition was poor, and we can show that through financials. Elsewhere, things are pretty quiet in oil. We'll have Oxy reporting. It doesn't really matter what they report as long as Warren Buffett keeps buying the stock. Interesting, we also mentioned in passing that Carlos Slim actually has a big position in PBF, which lowers PBF cost capital, and they'll be reporting this week. Really levered refiner, really like those guys. Refining margins are looking absolutely great. The trick with refining margins at the moment is there's a lot of downtime in refining, and so you don't want to get too misled into thinking that the oil market's strong. It'll actually be quite bearish for crude markets because there's so much refining turnaround coming. So while refining margins will soar, there's a double issue here. Firstly, you need your refiner to be running, and some of them have a lot of downtime, and so they won't see the benefits of the high Q1 margins because they're not running their refineries. And secondly, it will tend to pressure crude markets a little bit as the refining system in the US goes through turnaround here, basically around the next couple of months before we start ramping up into Memorial Day. So just watch out for some softness in crude prices here. Very good refining margins. We like the refiners. We love FANG. And one of the key read-throughs from this FANG deal with Endeavor is definitely our top pick for the year, which is Permian Resources. Is also very much the key scale player that's left, pure play in the Permian, that is still completely independent and not tied up in a deal. Have a great week.